Hi student, good day. I hope you are doing well and wish you all the best for your ACCA financial reporting. Today our chapter 2 is our tangible non-current assets is our topic, and this is we are going to go through a complete chapter review, and this is from ACCA financial reporting Kaplan study text we follow, and we complete our lecture and revision and pass card in Kaplan study text format, and we follow all these things. Okay, today's topic is the tangible non-current assets. So first of all, by the name itself, you know what is the meaning of tangible non-current assets. This is a basic things. If it is clear to you, and then the whole chapter will be easy for you. Students, tangible non-current assets mean the tangible something which we can touch it, and but it is not a current assets, but we have a presence in our premises or in our factory, like a machinery, equipment, and a vehicle. All these are the definition of tangible non-current assets. Like as you know, in chapter 1 we have gone through the current assets are those assets which can be converted into cash, like cash in bank, cash in hand, cash at in your safe, or wherever your business activities are there. In our account receivable are also can be considered if there are short term, and then your stocks, inventories, all these things are the coming under the definition of current assets. According to definition of current assets, it says anything which we can convert within the less than the period of 1 year, it considered as a current assets. And then which is the item which we cannot consider or cannot convert into cash in more than 1 year, then it comes under the non-current assets. The complete objective of this chapter will be we will discuss about the initial measurement of non-current assets, as it's mentioned over here. We will discuss identify subsequent expenditure that may capitalize, distinguish between assets and expenses. So the meaning of subsequent expenditures, if the meaning of that assets is some expenses we incurred on the assets for the repair, maintenance, which asset is a part, which expense is will consider as a part of your asset increase in value terms, I mean. Or if some expenses, if you are making a just maintenance, repair, maintenance, that will be expense out, that cannot be come under the capitalization of asset. So that we will discuss. And then they discuss the requirement of IAS 16 in relation to the revaluation of non-current assets. The revaluation also and will be a new term for you if you are in F7 paper the first time. So evaluation means every year they reconsider the value of the asset, whether it is increase or decrease, like inflation or something happen in the country or overall environment, like vehicle value may be increase or decrease after 2 year 3 year time, or like a building value or property land and building value increase. So this is coming under the revaluation. Might be some properties like 5 year before it was valued at 5 million, and now in currently, so these are valued at 25 million. So difference will be considered as a revaluation gain, so that we will be discussing over here. So how the revaluation and disposal gain or loss or non-current assets is treated, we'll discuss. Then compute depreciation. This is the one of favorite topic. If students who are coming from BCom side, they are well aware about it. If the newcomers who have done previously, they definitely familiar with the depreciation term. Apply the provisions of IAS 20 in relation to accounting government grants. So we'll discuss government grants also. What are these grants and for what purpose it is coming, and how we utilize, how we book for, and discuss why treatment of investment property should differ from other property. We will discuss IAS 14, like agriculture things we will discuss in this chapter. So after completion of this chapter, you will familiarize with this all these terms, like investment properties, like IAS 14, tangible non-current assets measurement, how it is measured, and how under IAS 16 you have to remember it is coming under non-current assets definition. So you have to memorize as we discussed earlier. So asset, all IFRS, IAS standards, so you have to memorize to gain your easy mark and free marks. This is this thing you have to make your habit. So whatever asset or whatever relating to any topic, if you going through or you're practicing, you should also remember with their IFRS code as well. So it will, if it is a part of your habit, so then it is easy. So when you are writing your exam paper, so it will gain you extra half mark by this habit. Under IAS 16, depreciation, IAS 16 coming under revaluation of assets, borrowing cost, we will discuss that is a separate IAS is applicable for we discussed over here. Government grants is also different. Then under depreciation, so change in method or the change in estimate, we will be going through this topic as well. And then under revaluation, how revaluation it is happening, so how the price change we will affect in our books of account, how the depreciation revalued of assets, how it will be treated in your books of accounts. We will discuss all these topics, so it will be easier, we make it easier for you to understand, to memorize and to practice and be prepared for your exam. This is a part of your foundation or the basic things when you familiarize with these, because these are starting things which are not going to test you, they test you on higher level. So definitely, but basic things you have to remember IAS 16. So you have to very much comfortable with the IAS 16, what is the definition and how the it is explained in the written form as well. So property, plant, equipment are a tangible asset held by an entity for more than one accounting period for use in the production or supply of the goods, as we discussed, for rental of others or for administrative purpose. Anything which is used for the business purpose, specifically it is used for business, so it will be considered as a property, plant, as a part of the asset of the company. Or if it is not used for a business purpose, or it's not helping a company to earn any money, like a private car or private use car, if somebody bring like 1 million value car, we add up for personal use, but it's just increasing to increase the assets value, but it's not contributing any worth or any return or any income generation is not happening, so it is not coming under the definition. So definition and the other law or their interpretation, you have to familiarize how it is recognized, because you are tomorrow's future the professional accountant. When something coming to you, you have to recognize how the recognition process will go through. This way IFRS, IAS will explain you the whole method like this. Recognition: an item of property, plant, equipment should be recognized as an asset when it is probable that for the future economic benefit of associated with the asset will flow to the entity. The future probable economic benefits associated with the assets. This is the main thing. This is the key words you have to remember for when you write probable with the future economic benefit associated with the asset, you will gain a mark. So marker is looking for the key points, whether you are aware about this complete procedure, complete process for the recognition of assets. So you are done with this thing. The cost of asset can be measured reliably. So mean it is there are the sources available, like if you have any vehicle, any model with the specification, all details, when you google it, you have a valuation is available, it is reliable sources available. If some assets like machinery, equipment, some are imported or some are technology, you have to get their way, the complete process will be, you have to follow. Okay, initial measurement. So now how the initially the assets value will be measured. So like any assets, and now we are Going forward, include all costs involved in bringing the assets in working condition, like a generating set. So you are bringing it, you have other associated costs, you have to make a foundation, you have to make all cabling and all these things. So it will include all cost involving with the bringing the assets of the working condition. This is one thing you have to fulfill. Include in this initial cost capital costs such as the cost of site preparation, delivery cost, installation, borrowing cost. We will discuss in detail borrowing cost. It's a complete session is there in this chapter. We will go through the borrowing cost will also be a part of your assets recognition. It can be helpful for you. So like if it is you are paying any finance cost for the purpose of the assets utilized for the company business purpose, so it will also be a part of you can consider it in the assets. Expense items such as fuel, training and warranty costs should be written off as incurred. So like if anything, if you are checking testing your generating unit for 5 days or 1 week, so any fuel cost is not a part of asset. It's a burn, it's over. Training or warranty cost, if you have sent somebody your of your employee for a training to other country, so that will also not be a capitalized. So that is because it is not associated with this thing, because employees are not your asset of the company. These are human capital, but it's not part of your asset. So dismantling cost also will be very much important. So there are in some countries there in some any assets like which is dangerous for a community, or you have to dismantle that one also. So at the time of completion of the work, so dismantling cost will also have to account for the future perspective, how it is they will treat it. So this is we will discuss over here. So this formula you may need to use the interest rate formula. So for the discount factor, if any assets or any finance cost you are bearing, so you have to make apply this formula to calculate their value at the present time. So it will clear you in this illustration. We can do that. If an oil rig was built in a sea, oil rig, I mean, you know that rig is for the purpose of some storage or some material they store in the oil field. The cost of capitalize is likely to include a cost of constructing the asset and the present value of the cost of dismantling. So mean they construct a rig and then they have to consider their dismantling cost as well, when after the completion of that project or a completion of that life of the assets, so they have to dismantle that one as well. So if the asset cost 10 million to construct, so they construct a rig, 10 million is a cost, and then 4 million would cost them in 20 years time. So how that will be calculated? So they said that you apply the formula for the interest rate formula 5% for the present value for dismantling the asset. So this is a purely F9 question. So you have if you have done F9, so you will be very much find it very much easier for you. But if it's in your next attempt, then no problem, it's a easy formula. So you have to follow this formula as we in the previous sheet it was mentioned there, like 1 plus r over n is a number of period, number of years. Like if it is a 20 years, so is a power is a 20. So then 1 plus r is there or complete. We have to how we have to follow their formula. Like they said 4 million is your total assets value for the dismantling cost. 4 million, we apply 1 over 1 0 5. 5 is a rate is a 5, and 20 is a your years how many 20 years time you have to cover it over there. So it is coming like 1,507,558 in terms of dollar. For 4 million present value you have calculated at that time. Now for the 20 years time you have this value for the yearly value you have to factor for the 5% factor you have to apply over here. The total to be capitalized 10 million plus 1,570,558. This both figures we have to capitalize in our books of accounts as we calculated this one, and then this would be depreciated over the 20 years time. So 20 years time how we will depreciate, then 11 million is coming here for we divided it with the 20 20 per year depreciation would be like this. And then how we will calculate, how we will account for each year liability would be increased by the interest rate of 5%, as we have make a present value of this 5% on the 4 million finance investment value. How much we have to consider in the present value term? It will be 5%. If the year one would be in that liability increase 75,378, making the year liability with the 1582. How it is calculated? 75,000 is a is a calculated for the purpose of our 1,570,558. We have divided by 20. If we divide it with the 20 years, it's coming to the 75,378 for the yearly per year liability we have to calculate. So this amount is coming. So then after that we will add it on like with this amount for 1570. So like this one here for 20 years time we have calculated. Okay, so this amount plus this amount 75, we will add up both figures, and then 1,582,000 will be our for the first year. In the year one, this would mean that liability increase with the 75, and then year end liability would be amounted to 1,587. If you have any question relating to this, you can comment or you can ask a question. I'm daily updating my feedback as well. So for those students who are my paid who avail that paid for services for revision classes and all the study material they will get, so they can have WhatsApp support. So definitely they will be explanation will be available, but I am sure this is a easier thing, so you can revisit this area, and it will help you to understand the concept. Okay, now the next is the subsequent expenditure. Subsequent expenditure, as we explain, so subsequent expenditure, property, plant, equipment should be only be treated as a part of cost of the assets if it is fulfill these areas. If it enhance the economic benefit provided by the asset, this could be extending the life of asset, expansion, or increasing the productivity of assets. So this is if they fulfill this area, this rule, then only you will recognize it in your books for the subsequent expenditure. If it relates to an overhaul or require a major inspection, like example, the best example for the overhaul of the aeroplane or any asset which is like a 10-year, 50, 20-year use, and then they overhaul, they may add a new component. So not whole that, but some part of this one they change it, so that can be considered as a overhaul, or they can treat it as a part of their assets. If it is a replacing the component of an asset made up of a number of component, each like a aircraft comprising body, engine, and the interior, all with the different expected life, the replaced component will be de-recognized. Okay, so the replaced component will be de-recognized, so if it is not fulfilling this their definitions. Like all other subsequent expenditure should be recognized in the statement of profit and loss, because it merely maintains the economic benefit originally expected. For example, the cost of a general repair should be written off immediately, expenses out, and consider in your expenses. Illustration 2, they just it's a easier one, just for to more clarity on your this understanding. The piece of machinery has an annual service cost 10,000. During the most recent services, it was decided to replace part of the engineering, meaning that it will work faster and produce more unit of product per hour. The cost of replacement is at 20,000. So what will be the treatment? Would this expenditure be treated as a asset or expense? So read this paragraph again and then think carefully. Then you see the solution. They're saying the 10,000 servicing cost is an expense item written off the statement of profit or loss immediately. So because this is a service annual service cost, like if you are paying a service of any equipment, machinery, or a vehicle, annual agreement, so expense out. This is not part of your life of the asset. This one, 20,000 replacement part enhancement future economic benefit. So this is a future. It is also a abbreviation of FEB. You, if you just remember this term, FEB, future economic benefit. If it is fulfilled by the future economic benefit, and so its assets, and increase the cost of non-current asset in the statement of financial position. So you are done. Okay, so the topic is clear. So we going very fast, but if you are not clear, you just watch it again. But it is a very easy, so there is no rocket science. Okay, definition of depreciation. So this is again the students from BCom or previous learners, they very much familiar with the depreciation, very easy thing, but it is a complete paragraph, complete definition or under the property, plant, equipment. This is also a part of that. Your good marks are there, so try to clear this concept. So depreciation is the amount of the asset of an asset or other amount out substituted for cost less its residual value. So this is the basic things. Like depreciation must be charged from the date of asset is available for use. It is capable of operating in the manner intended by the management. Okay, this may be earlier than the date of is actual brought into use. For example, if staff needed to be trained to use it, depreciation is continued even if the asset is idle. Okay, so this is a, but you have to consider it if you are a working professional. So again you have to consult with your auditors for further guidelines. So depreciation method used for the straight line, reducing method, and machine hours. So these are the accountants very well aware. So there is a no further explanation because everyone is well aware about this method. The change from method, if any changes is happening in depreciation method, this is permissible only on the ground that a new method will give a fair representation of asset of the financial position, does not constitute a change of accounting policy. This is also important. This is a many a small question or objective question, it is asked, they test you. Does not constitute a change in the accounting policy. The depreciation cannot be applicable or allowed or change in this one if it is happening. Is change in accounting estimate. Okay, so change from one method to other. So this is the reason you have to very much careful. Again, illustration 3, depreciation amount. Asset cost 100,000 and has an expected useful life of 10 years. The purchaser intends to use assets for 6 years. He intends to use. He is planning to use it for 6 year times. So definitely, so life of the asset for him will be 6 years. Which point of the expected residual value will be 40,000 at current price. Residual value, all of you aware, the residual value is that one the value of the future time after a period of 6 year. They estimate its residual value, like when they finish it. Residual value mean like you have some any vehicle, any make, that definitely it has a residual value after. If you have 10-year-old model, so now itself it has a residual value. If you are disposing it off, maybe in your books of account it is a zero value of the asset, like after 20% depreciation. But now after a 10-year time, so that definitely have a residual value in your books of account when you sell it. So depreciation amount would be 60,000, like 100,000 minus 40,000, they will deduct the residual value. So for the that will be divided or spread it out over the 6 month 6 year times. Major inspection or overhaul cost. So it's just a little more understanding or on this one. Inspection and overhaul cost are generally expense as they are incurred. So like inspection or overhauling, they're just expense out. So that's not much detail required for overhauling. So these illustrations are there. So we will do it in our other all further classes. In the revision classes you can find it all explanation. Okay, revaluation of non-current assets. So as we discussed earlier, the revaluation of non-current assets is happening. This is allowable, permissible under the IAS 16. How it is treatment is happening, how the value of asset increase or decrease we can apply in our books of accounts. IAS 16 allows a choice of accounting treatment for property, plant, equipment, plant equipment cost calculated as a cost model or revaluation model. So cost model mean if it is something you bought it 1 million, so to continue or keep depreciating over their life, so that is a cost model. So if a revaluation model, you purchase it in 1 million, like example of vehicle, 3 years before, now vehicle value might increase, or any building or any equipment value increase or decrease. So if we apply this method, so that is called a valuation method. Under cost method, property, plant, equipment cost less accumulated depreciation. This is a simple one. And then this is the revaluation model will be there for property. Plant and equipment may be carried at revalued amount less any subsequent accumulated depreciation. If the revaluation alternative is adopted, two condition must be complied with. The revaluation must subsequently be made with the sufficient regulatory to ensure that the carrying amount does not differ materially from their fair value each reporting date. When an item of PPE and equipment is revalued, the entire class of asset to which the item belongs must be revalued, not a cherry pick. It must be applicable to all asset class. It's not just if one asset is increasing, you are applying a revaluation model, and some part of asset or other component or other in the factory something is not is a decreasing side, so you cannot ignore it or remove it. It will applicable to whole class of assets.